Interesting.
Just remember something. When the inflation rate is high, the public doesn't tend to vote you back into office.
Yeah.
Tend to lose your job, okay, if you're a politician. Right. And remember that all the government benefits like Social Security and all the government employee payroll is indexed to inflation.
Yeah.
And the government is now about 20% of the economy.
That's
the government employs so many people, and if they have to give COLA wage increases, cost of living index wage increases, they have to do it at the official rate of inflation. So if you can understate the official rate, you get to pay less, give a smaller raise.
Yeah.
Okay?
Shout out Sean, man.
Changing the game through real estate, yeah. Changing the game through real estate. I can never wait, got what it takes to got this on my plate. And I got a budget, teach you how to save. Listen to this podcast, you will be amazed. Play this any morning, any night, any day. We're the winning team, we were born to be brave. Yeah, changing the game through real estate, yeah.
So I actually heard about you past in July. So I went to Bridger's Fund Launch Live, and I wasn't really sure what to expect when I went there. And then I've actually never heard about you before that moment. And I heard you your speech on at Fund Launch Live, and I loved it. I loved how you analyzed deals, how you broke down the economy. And I'm really curious from I know a lot of people weren't there, what's your perspective of the overall economy is right now?
Sure. Yeah. So, so first off, just so people have the background, my name is Jason Hartman. I'm CEO of Empowered Investor, and we basically teach people how to invest. We teach them about economics. We make market predictions and forecasts. And I've been doing that for about 18 years now. And we have investors from all over the world that invest in properties with us all over the United States. And so we get a lot of insight into different markets. We get a lot of feedback from thousands and thousands of clients on what they're seeing. Also, all of our affiliates through our network and what they're seeing in the market. And we just spend countless hours analyzing and studying the market, the economy, and coming up with some, really innovative ideas that you probably haven't heard before. And I'll share some of those today. But, overall, my view right now is that the market is clearly changing. These high interest rates are really affecting things. And, but it's spotty. There's a lot of nuance to it. I think that I divide markets into three major types: linear markets, cyclical markets, and hybrid markets. And most people pay attention to the cyclical markets because they're the sort of the trophy markets of the United States or the world, right? And these are like the West Coast of the United States, the expensive Northeastern markets, and South Florida, where I live. These are the high-flying markets that get all the attention. But what people don't realize, and those are the cyclical markets, LA, San Francisco, New York, Washington, DC, Boston, Miami, those are cyclical markets, right? And there are many others. But what most people don't realize is the vast majority of the country is linear markets. And these are these slow and steady markets that don't really make the news. These are the markets that are good markets to invest in because they have stable fundamentals, they have good cash flow, and they just make a lot more sense. The properties are a lot less expensive, and they are the markets investors want to pay attention to. So when we look at these two different sets of markets, and hybrid markets would be the in-between, obviously, we see them act very differently. So right now, and our forecast in the future, is that cyclical markets will continue to soften pretty substantially. And I would be very careful of buying properties in those markets. But linear markets, however, where you're looking below the median price in any given market, are markets where they're still experiencing tremendous housing shortages. Since coming out of the Great Recession, for the last 12 to 14 years, depending on how you count, builders have not built these inexpensive entry-level houses. And so there is just a huge shortage of those properties, and it's going to continue. Why haven't builders built them? Well, they're simply not profitable. It's too expensive to get the entitlements, to put in the infrastructure, to pay for the construction materials, the labor. You just can't build them at a profit anymore. And so this shortage in entry-level housing will persist for many, many years to come. And that will be the protection against any downside risk. And that's why I think those properties make a lot of sense. But the problem is that all of the data we see is just looking at the overall housing market. They never really divided up into cyclical, linear, and hybrid markets, and they never divided up based on price segments. And so it's really problematic. Okay, and that's what we can take a deeper dive into today.
So how do someone determine like whether like it's a good linear market or not? Like a lot of people have like questions like, okay, am I in a linear market? What's some kind of like factors that people can kind of determine like if that's a good linear market or if they are in a linear market?
Well, the way you know if you're in a linear market or a cyclical market is by the prices of land. So land prices are always higher in cyclical markets, and land value can fluctuate dramatically. It has a lot of volatility with it. However, improvement value, okay, and many years ago, I developed something called the Hartman risk evaluator. And we're not going to go over that today, although we could maybe another time. But basically, what it does is it teaches people how, when they buy a property, most people think they're buying one thing, and they're really buying two things. They're buying the land and the improvement, or the house or the apartment building sitting on that land. And land prices are very volatile. Improvement prices, the house, the apartment sitting on that land, not very volatile. Why? Because it is made of materials, commodities. And I call this packaged commodities investing. So if you think about it, just look at the ingredients of a house, right? So look behind me, I'm in my house, and you've got these walls, right? You've got drywall, you've got lumber, you've got concrete below me, you've got petroleum products throughout. I've got glass and steel. I've got copper wire in the walls. All of these commodities are traded globally, and they're not attached to any one currency. They have intrinsic value, regardless of whether they be traded in the dollar, the euro, the yen, or the peso. It doesn't matter. They have intrinsic value, and they are much less volatile than land prices, which can go up and down very, very quickly. And so linear markets have a low land value component and a high improvement value component, or packaged commodities component, because I call it packaged commodities investment. We buy all these commodities, they're packaged up in the form of a house or an apartment building. And they're not very volatile. I mean, yes, commodity prices, of course, go up and down. The price of copper changes, the price of oil changes, which are the petroleum products, drywall, lumber, concrete, etc., glass, steel, they all change, but not nearly as quickly as land prices.
So you're looking at basically deals that when you look at the like even like the tax assessment, majority of the value is in the value of the property, not in the value of the land.
Yeah, well, the value of the improvement, the house sitting on the land. The property is considered the whole thing, right? Yeah. That's what people mostly sort of incorrectly call it, right? Yeah. They say, yeah, I bought a property. It's a piece of land with a house on it, right? So yeah, we like to see a ratio somewhere in the neighborhood of 80-20. So if 20% of that is land value and 80% is improvement value, that's pretty good. Now that ratio, as prices have gone up, has become more and more out of sync. So maybe nowadays it's more realistic to look at 70-30. Yeah. But if you're looking at a property in Los Angeles, where I grew up, for example, or Miami, which is just about an hour south of me, I live in Palm Beach, Florida. You're looking at very high land values. It's almost the inverse equation, and so those can fluctuate much more dramatically.
So is that where you see the biggest correction is going to be in land? Because they're doing I don't really understand fully what the Fed's doing. I feel like they're almost trying to force a crash.
Oh, they are. Yeah, they're going to put us into a recession one way or another. I mean, if we're not already in one, and that's debatable, of course.
Yeah.
Yeah.
So why? Like, why do you think they're trying to do that?
Well, they've got to cool inflation. So there's something in economics, there's a major principle that's important called the Phillips curve. And the Phillips curve is the equation where you try to balance unemployment on one side against inflation on the other side. Because when the economy runs hot, you're going to have inflation, where you have more dollars chasing a limited supply of goods and services. You're going to have wage inflation, you're going to have consumer price inflation, producer price index inflation. All of these things will inflate in price, right? When you have more dollars chasing a limited supply of goods and services. And you'll usually have very low unemployment in that environment. So as they bring up interest rates and tighten the money supply and rein it in so there are fewer dollars chasing the existing supply of goods and services, then those prices will subside and inflation will calm down. And the Fed's target rate is 2% inflation, okay? So we are way above that now, and their mandate is to keep this balance between, a good, healthy economy with fairly low unemployment and low inflation at the same time. And it's hard to do both, right? And I am hugely critical of the Fed right now. They have completely screwed this whole thing up. They let the economy run way too hot for way too long with these ridiculously low interest rates. They should have raised rates much sooner and much more gradually. And now they're raising rates too quickly, and they're behind the eight ball because inflation is out of control. So it's a difficult problem to solve. They have really put us into a mess.
Yeah, because it was I think back in January it was about 3.5%, and now I believe it's up to like 7.5%. That's a massive.
No, it's higher than that, and that's just the official numbers. I mean, the unofficial numbers I believe are 15 to 17% inflation right now.
Yeah, I was talking about the interest rates. Interest
rates.
Got
3.5
to 7.5. So I know you love like using debt for real estate. Do you still see the value of using debt even if it's at like 7.5 to 8%?
Yeah. Well, that's a good question, and the question there is compared to what? Yeah. Because which I believe, as you know, is life's most important question.
Yeah.
and I talked about that in the speech that you saw. So you have to compare the cost of money with the cost of inflation, right? Because when you have inflation, let's use 15%, and you can borrow money at 6%, the delta between the two is 9%, right? Yeah. So that's the difference, okay? So inflation is still paying you to borrow money. We still have negative real interest rates compared to inflation, because if you're a lender, and I'm a lender, by the way, I do hard money loans, I do private loans all the time, and so when a lender loans money and they're saying, here's the money at today's value. If I give you $100,000, that $100,000 is, you could spend it today and it would be worth $100,000 of whatever goods and services you could buy. But if you're going to pay me back over the course of 5 years, for example, I know that officially at inflation around 9%, I'm going to be losing $9,000 the first year I loan you that money, because you're going to pay me back cheaper dollars than I gave you, right? So comparing the interest rate I might charge you of, say, 6% in that example before, and a real inflation rate, well, an official inflation rate of 9%, you're getting paid 3% to borrow the money in that example. The unofficial rate of 15%, which I believe is a more accurate number, you're getting paid 9% to borrow the money, because you get the use of it today and you pay it back in cheaper dollars tomorrow. It's a very, very good deal. And I actually trademarked a term for this years ago, and I'll just share it on the screen. I call this inflation-induced debt destruction. And I've been teaching that strategy for about 18 years now, and it is really the hidden wealth creator that can be used most successfully with income property. Real estate has very special characteristics that make it the most historically proven asset class in the entire world, one of which is inflation-induced debt destruction, but there are other great characteristics too.
Yeah, I don't think I've ever I've seen your breakdown for your inflation. Is that part of like a program you do, or?
Well, yeah, I mean, I teach all kinds of things on my podcast and my YouTube channel and at our live conferences. One of them is the inflation-induced debt destruction strategy. The other is the Hartman risk evaluator, and there are many, many other things. One of which you heard me talk about is the new index I've developed called the HCI, or the Hartman Comparison Index, which basically helps people compare the value of real estate to a whole basket of things rather than just one thing, which most people compare it to, which creates huge blind spots. I mean, think about it. The vast majority of people, almost everybody, compares the value of a house to one thing, the US dollar.
Yeah.
Why would you do that? That's the US dollar is a moving target. The house price is a moving target. You're going to have a ton of blind spots if you don't use multiple measuring sticks to compare and understand value with. That's a very, very big problem. And that's what I hope to correct by teaching people about the Hartman Comparison Index.
Yeah, are we able to jump into that? Because I know one of the biggest questions I get asked all the time is like, "Hey, should I buy a house? Should I not buy a house?" And I love how you break it down to like, well, compared to what? And I feel like that's a very big question going forward and going to the crash, and might help determine whether or not people should buy or should not buy a house.
Yeah, absolutely. So, I'll just show a couple visual aids on the screen. If people are only listening to this on audio, I'll try and speak what we're looking at visually so that it'll make sense to them too. But the important thing is, again, to understand what measuring stick you're using, and to not only have one measuring stick. And that's what the Hartman Comparison Index solves for. And so let's just look at a couple things here, okay? So there's a tale of three markets: linear, cyclical, and hybrid markets. We talked about that. The linear markets, slow and steady and profitable. Cyclical, they're like a roller coaster ride. Hybrid, between the two. And just a couple examples real quickly in looking at that compared to what question is understanding is real estate cheap or expensive? That's what we've got to do. That's why we have the index. And, that's the most common question I get asked, the one you just asked, Are we in a bubble? When's the bubble going to pop? And we talked about packaged commodities investing and how that creates a lot more stability for prices. And we talked a little bit about inflation-induced debt destruction too. So here's a chart of the Case-Shiller Home Price Index compared to the Consumer Price Index, the most widely used measure of inflation. And you can see that mostly historically, they're pretty much in sync, but they do get out of sync a bit, okay? And so we're going to kind of look at that. There are many other indices. I don't have time to go over all of these, so I want to jump right into the Hartman Comparison Index. And here, what we see is we're going to compare the typical house to not just US dollars, but also to gold. Now, I'm not a gold bug. I just think it's a good measuring stick. Okay, gold has been considered money for thousands of years. Yeah. And it's worthwhile to use this as one of our comparisons, and the first one actually. So if we look at back in 1970, the median home price was about $23,000 and gold was $35 an ounce. So it would take 654 ounces of gold to buy the median price house back then. But 10 years later, the median house had tripled in price to about $63,000. And gold had gone way up in price too, to $653 an ounce. So 10 years later, it only took 97 ounces of gold to buy the median price house. Now, we can go through the decades, and we just did an update bringing us up to last month. Okay, so this would be very current data. Now, last month, the median house price, and by the way, this varies a little bit depending on what survey you're using, okay? Yeah. The one we use prices the median price house at $390,000 basically. And gold at just over $1,700 an ounce. So it takes 227 ounces of gold to buy the median price house. At the end of the second quarter of this year, it took 228 ounces. So it actually got 1 ounce cheaper. At the beginning of the first quarter, it was only 197 ounces. So it was a lot cheaper back then. And historically speaking, the most expensive it was in 1970 and in 2000. In the year 2000, 22 years ago, it took 520 ounces of gold to buy the median price house. So the question we have to ask ourselves is, priced in gold, are houses cheap or expensive? Now, we break this down also based on linear markets and cyclical markets as well. But again, we could talk about this for 8 hours and we wouldn't cover the subject. There's a lot to it. Okay. So just in the interest of time, I'll just move on. But the question to ask yourself, priced in gold, is housing cheap or expensive? The answer, it's not the cheapest it's ever been, and it's not the most expensive it's ever been either. It's kind of in between.
Yeah.
Okay, let's look at another thing. We're not going to look at Bitcoin. That's too volatile. Okay. But, but let's look at oil. Oil is a really good one because it's one of the most important commodities in the world, oil. No matter what the tree huggers and the green weenies want to say, the world still runs on oil. No question about it. So in 1970, that median price house was about $23,000. Oil was $4 a barrel. It took about 6,400 barrels of oil to buy the median price house. Today, median price house is about $390,000. Oil's just under $100 a barrel. And of course that changes hourly, okay, but at the end of last month. And it would take only about 4,100 barrels of oil to buy the median price house today. So priced in oil, housing is actually cheaper than it was 52 years ago.
Yeah.
Just think about that for a minute. It's also cheaper than it was a year ago in 2021. It's actually cheaper priced in oil. It's cheaper than it was in 2020. In 2020, 2 years ago, a median price house was only $309,000, but oil was $47. So it took 6,600 barrels of oil to buy the median price house. What if we go back 12 years? Let's go to 2010. House was $170,000, oil was $89. It only took 1,900 barrels of oil back then to buy a house. So it was cheaper back then. And you can see it varies over time, okay? I'm just trying to get people to look at multiple ways to price things. Okay, let's look at rice. What
about interest rates? Because I know most people I've talked to, like people that are buying the house, most people are not really worried about the overall price. They're worried about like how much they're spending per month.
Yeah, absolutely. Good question. And I'll be with you in a minute.
Okay.
We're going right there. That's where we'll go next. Okay. So let's look at rice though for just a quick moment, because rice is the basic food stock of 2/3 of the entire world's population. It's a really important food commodity. And so back in 1970, where we start, it took 43,000 hundredweight bags of rice to buy a house. Today, it only takes 22,000. So priced in rice, housing is actually very cheap right now. It's almost the cheapest it's ever been. It was a little cheaper in 1990, but pretty much otherwise, it's about the cheapest it's ever been. Okay. All right. We're not going to worry about pricing it in median income or the Forbes cost of living well index or copper or alcohol or haircuts or wheat or the Russian ruble or the Goldman Sachs commodity index. Let's talk about interest rates and let's price for that. So when we look at mortgage debt, debt service payments as a percentage of disposable household income, we see, looking at the end of this chart, that it's pretty low. Mortgage payments are actually pretty reasonable for people, historically speaking. Now, they were much cheaper during the COVID lockdowns. Okay, that was the cheapest time.
Your white screen's actually blocking the...
That is very much intentional.
Oh, okay.
So now I'm going to remove that, And we're going to go back further. Okay. So let's go back to about 2014. And we see right now the mortgage burden for the typical household is actually quite low. People are complaining that mortgage payments are so high. Compared to what? Yes, I know. Compared to the cheapest point where we had the lowest interest rates in literally 5,000 years during the COVID lockdowns, and house prices were very cheap then too because they hadn't risen yet in response to those low rates. Yes, I know it's more expensive than it was then, but that was a total anomaly. You've got to step back and look at the bigger picture. Mortgage payments are still pretty darn reasonable. Let's go back even further. Let's go back to 1984, okay? Or no, I'm sorry, this is about 1980, this chart starts at. And if you look at the mortgage debt payments as a percentage of disposable personal income, it's cheaper than it was in 1980, 1985, 1990. All along, the only time mortgage payments have been cheaper than today are during the COVID era. Otherwise, historically, big picture, going back to about 1980, mortgage payments are the cheapest they've ever been, with just those exceptions during the COVID era.
Yeah.
Counterintuitive to what people think. Okay. All right. Let's look at the real mortgage payment priced adjusted for inflation. Okay. So we start out at 1970 again, 52 years ago. And a mortgage payment on the median price house back then was $127 a month. But of course, over time, that $127 is debased by inflation because inflation eats away at the cost of things. So the nominal mortgage payment today, nominal just means in name only. That's just the name of something. I still call a dollar, even though it had the same name back in 1970, still called the same thing, right? The nominal mortgage payment today is $1,810, but adjusted for the official rate of inflation, not the real rate, because we know it's totally understated and manipulated, as we talked about earlier. The real mortgage payment today on the median price house is $238. Now, that is more expensive than it was 52 years ago. No question about it. It's not the most expensive ever. It was actually more expensive in 1980, where it was $253. And it was more expensive at the second quarter of this year at $261.
Yeah.
But other than that, it is more expensive than it has been historically. But what if we adjust for the real inflation rate? Now, I've interviewed on my podcast the founder of a website that everybody should know about called shadowstats.com. And his name is John Williams. And what he does is he calculates real inflation based not on his own idea or opinion. He simply does it the way the government used to do it before they started manipulating the index so heavily.
Yeah.
Okay. And by the way, when they started doing that was around 1980. So if you calculate it the old way, the government's official way, and you apply that to today, let's look at what we come up with. So again, we got that same $127 in 1970. We go through time and there's inflation. The nominal payment today is over $1,800. Adjusted for the official inflation rate, it's $238. But if you calculated it the way they used to have the official rate of inflation, it would only be $70 as of the end of last month. So priced for housing prices, inflation, and interest rates, are houses cheaper or more expensive today than they were 52 years ago? They are cheaper, almost by half.
So why did they switch from how they used to do inflation to how they do it now? Why did they switch? Just manipulating on what?
Because the inflation rate was very high in the late 70s and early 80s, and they wanted to find a better way to lie to us.
Yeah, I got you. Because they manipulate the CPI all the time, don't they?
Oh, of course, that is the measure. So when I say inflation adjusted mortgage payment, that is the consumer price index. What the next column is the shadow stats index, which is the old way of calculating the CPI.
Oh, okay. Huh. Interesting.
Just remember something. When the inflation rate is high, the public doesn't tend to vote you back into office.
Yeah.
Tend to lose your job, okay, if you're a politician. Right. And remember that all the government benefits like Social Security and all the government employee payroll is indexed to inflation.
Yeah.
And the government is now about 20% of the economy.
That's
the government employs so many people, and if they have to give COLA wage increases, cost of living index wage increases, they have to do it at the official rate of inflation. So if you can understate the official rate, you get to pay less, give a smaller raise.
Yeah,
okay?
Makes sense.
So, yeah. So I hope I've enlightened your audience a bit with some new ways of thinking. And I really encourage people to take a deeper dive into this stuff because you'll be amazed at what you see. It is not the way people think. Now, just let me wrap up on this concept here on the chart that you see on the screen. Because a lot of people might be saying, Jason, that's ridiculous. Are you kidding me? You know, I was alive in 1970 and I remember, you know, the house my parents paid the mortgage on, you know, the $127 a month if it was the median price house, right? And, you know, no way. Like today, I can't even afford a house. You know, I'm the child of that parent that owned that house, right? And but I would really encourage you to think more clearly about that. And here's why. We as humans do something called hedonic adaptation, okay? And hedonic, the root word of that is hedonism, pleasure seeking. We're all, you know, hedonistic and we seek pleasure, right? So how much pleasure do we get out of something? And what we do is we adapt to things. We take things for granted after a while, right?
Yeah. And
we take for granted how the house we live in today, even though we think it's so unaffordable, is a lot better than the house we lived in when we were a kid in 1970, okay? And it's a lot bigger. Look at this, okay? Well, this isn't the chart I wanted to show you. Okay, hang on. Let me see if I can find that chart. Here it is. This is the average square footage of houses over time, right? In 1970, the typical house was 1,500 square feet. Okay?
Yeah.
Today, the typical house is over 2,200 square feet. Okay? It's much larger. It's a bigger house. So when you adjust for square footage, interest rate, inflation, and house price, what you see is that the shadow stats adjusted mortgage payment per square foot on the house was 8 cents per square foot in 1970. It was 14 cents per square foot in 1980. It came down again to 7 cents in 1990, and on and on. Today, it's 3 cents per square foot per month. We're getting more house for less money than we did 52 years ago. Yet the vast majority of people do not see this because they're not really looking at the nuance.
Does Shadow Stats website, do they show you exactly how they come up with their like algorithm and how they?
Oh, they've got tons of articles and things about it. But remember something, it's not their method. It's not their algorithm. It's the government's method.
I got you.
It's just the way they used to do it before 1980. That's all it is. It's not something they made up. It's what the government made up.
So I get asked this one question all the time. They think interest rates are going to go back down. I'm just going to wait out and interest rates are going to go back down to what they were lowest back in the last 5,000 years. Do you see that happening, or are they just?
I don't think they're going to go down that much again. Okay. That was a real anomaly. Okay.
Yeah.
And by the way, there are records of interest rates for 5,000 years. Okay. I got a great book recommendation for everybody. It's by the late David Graeber, who was a really interesting guy. He had an interesting way of looking at things. And the book is called Debt, the First 5,000 Years. Okay.
Yeah,
it's really quite good. You should definitely read that book. So I don't think the rates will go down that low, but I do think the Fed will kick us into a recession. You know, it's debatable whether we're in one now or not. I mean, unemployment's so low that it's hard to say we're in a recession, but you know, whatever. There's a lot of metrics. Okay, so they'll kick the economy into a recession. Inflation will cool off. And then everybody will be complaining that, you know, times are bad. You got to loosen the money supply, and they'll lower the interest rates. They might even do more quantitative easing, and then that will turn things around. Now, here's one of the great things about real estate. Okay, you know, mostly when you buy something, once you negotiate the deal to buy it, that's the deal. You're done. You paid the price. The seller accepted a certain price. The deal's over. It's done. But the beautiful thing about real estate, especially income property, which is different than real estate because it's used for rental and has different characteristics than just a house you live in.
Yeah.
Okay. Is that you can constantly renegotiate the deal over time. The deal you agree to today is not the deal you're stuck with. So for example, if someone buys a property today, now, I don't know if you sell properties or not, but we do.
Yeah, I
right?
do. I do a lot.
Okay, so you know, like if people went to my website or your website and they bought a property, right? They might think, you know, oh gosh, you know, this deal, it's not as good as it used to be, but I still got to put my money somewhere. I know if I leave my money in the bank, it's going to get eaten alive by inflation. The stock market's a disaster. The crypto market's a disaster. Compared to what? What else am I going to do? Real estate's still the last man standing. It's the best thing, okay, as it usually is. So say they buy a property today, although they're not that impressed with it because they're paying, you know, over 6% on the interest rate on the mortgage. If we go into that recession and the Fed lowers the rates, you just refinance in a year and a half.
Yeah.
Okay. So you can constantly renegotiate the deal along the way. That is one of the beautiful things about income property.
Yeah, I agree. Because I guess that's the main question everyone's trying to, like, definitely new investors and even homeowners is really trying to figure out, like, hey, should I just stack cash? Hey, should I invest in real estate? And I think that's kind of like a good way to see it.
Yeah, absolutely. It's the most historically proven asset class in the entire world. You know, it's made me very, very wealthy. It's made a lot of other people very, very wealthy, and it's a great thing.
Well, I appreciate you coming on the show and sharing your knowledge. It was a pleasure to officially meet you, and hopefully we can actually see you at another conference. I'm not sure if you do a lot of speaking events a lot.
Oh yeah, I do quite a few speeches and so forth. So I'll undoubtedly be on the circuit there. But you know, if people want to get a really deep dive into this stuff, it's really important. Listen to my podcast. It's called The Creating Wealth Show. We really dive deeper into these things as well as a zillion other important things.
Yeah.
And check out my YouTube channel. Just look up Jason Hartman, go to jasonhartman.com, and you can find my podcast on Spotify and iTunes and all the rest. Okay.
Yeah. So, and I actually listen to your podcast pretty regularly too. I really like it. I love how you break down economics too. So I appreciate you coming on the show, and it was a pleasure to have you on.
All right. My pleasure. Happy investing to everybody.